Every single day, millions of people spend hours scrolling feeds, watching random videos, and chasing viral trends. But while they are busy doing that, the wealthiest people in the world are quietly putting their money to work by buying assets. Working hard is no longer a guarantee of financial security. If you leave your cash sitting idle in a bank account, you slowly fall behind. It's not a matter of intelligence or effort. It's a result of an economy where wealth is increasingly built through ownership rather than just labor. True financial growth requires a fundamental shift. You have to stop working for money and start making your money work for you. One of the most effective tools ever created for that transition is the S&P 500. Most beginners try to enter the market by guessing which famous company will be the next big winner. They look at icons like Apple or Amazon and try to time their investment perfectly. Picking individual stocks is incredibly risky. Even industry giants can struggle or be overtaken by a better competitor. And for an ordinary person, choosing the wrong winner can mean a devastating loss. This risk often leaves people paralyzed, stuck on the sidelines while others build wealth. Investors found a way to bypass that risk with a smarter strategy. Instead of picking one stock, they used the S&P 500 to track 500 of the largest publicly traded companies in the United States simultaneously. Buying into the S&P 500 places hundreds of successful businesses into your portfolio. It functions like a giant basket, providing instant diversification. This basket groups companies into 11 major sectors, from technology to banking, ensuring your money isn't tied to a single industry. You already interact with these companies every day. When you use an iPhone, shop online, or search the web, you are interacting with businesses that are core components of this index. It also owns the physical infrastructure of your life. Whether buying groceries at Walmart or using a credit card for morning coffee, you are supporting the industry leaders that populate the S&P 500. Investing in this index ties your personal wealth directly to the unavoidable everyday spending habits of billions of people across the globe. Within this list of 500 companies, influence isn't distributed equally. Some businesses have a significantly larger impact on your investment than others. The index uses market cap weighting. The most valuable companies, the giants worth trillions, carry more weight. Like a sports team, a few star players drive overall growth. Defensively, if a small company fails, its negative impact on your wealth is mathematically insignificant. Market cap weighting acts as a self-defense system. It organically rewards the strongest economic players while isolating your money from the failures of the weakest ones. Because it covers such a huge portion of corporate America, the S&P 500 is the official benchmark for the U.S. stock market. When economists or governments talk about the health of the economy, this is what they are looking at. Professional investors spend billions of dollars on experts and complex reports trying to outperform the market. Yet over long periods, the vast majority of these institutional giants consistently fail to beat this simple index of 500 companies. The index isn't magic, and it isn't immune to loss. During wars, pandemics, or recessions, the market can crash, and investors will see the value of their basket decline. Historically, the index always recovers because it is self-cleansing. Weak companies are expelled and replaced by profitable innovators. It successfully navigated the transition from the industrial age to the tech boom, ensuring investors are positioned in businesses of the future. Investing in the S&P 500 replaces the stress of predicting winners with a single, clear decision. It is the simplest way to bypass the complexity of the market and secure a permanent stake in global wealth. If you spend time watching the news from the American Financial Center, you'll notice a pattern. The daily conversation is almost always dominated by the performance of just a few massive corporations. Why do a handful of names dictate the direction of the entire market? The answer lies in how the S&P 500 is built. It's a collection of 500 of the largest established companies in the United States. When you see a group this large, it's easy to assume every business inside has an equal say in the group's overall performance. In reality, the influence is heavily lopsided. A tiny fraction of these businesses, mostly giant technology companies, are responsible for the majority of the movement you see in the market. You can think of the index as a giant pizza. Every company gets a slice, but the sizes are nowhere near equal. Companies like Apple and Microsoft get massive portions of the pie, while hundreds of other businesses are left with tiny slivers. This imbalance explains why a few tech giants pull the entire stock market along with them, even when other companies are moving in the opposite direction. A company's influence is determined by a single rule called market capitalization, or market cap. The formula is simple. Multiply current share price by total shares issued. If company A is worth $100 billion and company B is $10 billion, A is 10 times larger. Market cap weighting gives larger, more valuable companies more power to move the index. Apple provides a clear example. Because its total value is so high, it carries a massive amount of weight. Think of Apple as a massive cruise ship and a smaller company as a tiny fishing boat. If both move forward by 5%, they've both grown by the same percentage, but the cruise ship creates a much larger weight. Because Apple is heavy, a 5% jump in its price physically pushes the S&P 500 higher. This explains why financial news reports focus so heavily on the performance of just a few tech names. A company's total size determines its ability to steer the direction of the country's most watched financial metric. It is also important to know that the S&P 500 is not a permanent list. It functions like a professional sports league that must draft new talent and cut players who are no longer performing at the highest level. A committee reviews companies to see if they qualify for the draft. To get in, a business must be based in the US, its shares easy to buy and sell, and it must be profitable. When a fast-growing company finally makes the cut, it signals to global investors that the business has reached the top tier of the American economy. But just as easily as a company enters, another can be removed. If a company's value shrinks, its finances weaken, or it gets bought, it loses its spot. The index then replaces it with a stronger candidate. This constant cycling ensures the index only represents the most successful businesses in the country at any given moment. This shifting, size-weighted system allows the index to adapt to the future automatically. Decades ago, manufacturing and industrial firms held the most power. Today, software and internet companies rule the leaderboard. In the coming years, entirely new industries like artificial intelligence and advanced robotics will likely rise to prominence. As those new industries grow in value, the S&P 500's mechanics will naturally elevate them to the top of the list. This ability to evolve is why investors have used the index to track the growth of the American economy for decades. It tracks 500 companies, gives the largest ones the most influence, and regularly replaces the weak with the strong. This design makes the S&P 500 a direct reflection of the actual shifts and changes within American business as they happen. In the next video, we'll look at how this index has actually performed over time, including how it has survived major market crashes and helped investors build long-term wealth. Imagine waking up to find that a $1,000 investment made years ago has grown into tens of thousands of dollars. No lottery ticket was involved and no overnight success occurred. This was simply the result of patience. Millions of people use the S&P 500 to build wealth this way. The process doesn't require picking a lucky stock or correctly predicting the next market crash. This chart anchors the historical average annual return of the S&P 500. Over long periods, it delivers approximately 10% before inflation. In practice, that number averages incredible and terrible years. While rarely flat, decades of performance result in this 10% constant. Investors trust the market with their financial future because they focus on this long-term history rather than attempting to forecast unpredictable, chaotic events. While 10% might sound modest, it serves as the foundation for the most powerful engine in finance, compounding growth. Albert Einstein is credited with calling compound growth the eighth wonder of the world. Regardless of the origin, the mechanical reality is what matters. Compounding functions as a loop. Your money earns a return, and then those returns begin earning their own returns. Over time, these layers of growth start to accelerate. As this curve bends upward, it shows how an initial $1,000 investment behaves over several decades. Without adding any new money, the growth rate begins to accelerate exponentially. This is the starting point for wealth building. It is less an act of cleverness and more an act of mathematical patience, simply letting the compounding loop run uninterrupted. Market history looks smooth on a long-term chart, but the actual experience of investing is filled with crashes and recessions. In the late 1990s, excitement reached extreme levels. Investors poured money into technology stocks, convinced that internet companies would make everyone rich overnight. Then the bubble burst. Stock prices collapsed, billions of dollars vanished, and the panic that followed felt like the end of the world for many. The market eventually recovered, but was soon hit by the 2008 financial crisis. Major banks failed, housing markets collapsed, and unemployment surged across the country. As the S&P 500 lost massive value, fear dominated headlines. The decline was so severe, some believed the financial system itself might fail. Just over a decade later, the market faced another shock with the COVID-19 pandemic. Entire countries shut down and travel stopped. Global uncertainty exploded as businesses closed and normal economic activity came to a halt. The speed of the decline shocked investors around the world. Markets fell rapidly, and once again, predictions of a permanent disaster became common. These events share a pattern. While a crash is happening, it feels permanent, insurmountable, and entirely different from anything that came before it. Feeling the urge to sell everything and exit the market during these periods is a natural human response to loss. However, the primal fear of a downturn is often a greater threat to an investor's wealth than the downturn itself. History shows that despite the panic of every crisis, the market eventually recovered and climbed to new highs. This resilience is driven by businesses adapting to survive. Companies innovate, increase productivity, and find new ways to produce value even after a disaster. Technology's evolution illustrates this growth. The internet emerged, smartphones changed communication, while artificial intelligence became reality, alongside dramatic advances in healthcare. The companies within the S&P 500 drive this progress. Investing in the index is a way for individuals to benefit from that collective economic growth. Confidence during a crash comes from believing human innovation and productivity will outlast any temporary crisis. Imagine two investors. Both start at the same time, but use different strategies. Investor A tries to time the market. They wait on the sidelines for a perfect entry point, trying to forecast economic events to avoid the next crash. Investor B starts immediately. They stay invested through every crash, never attempting to predict when the market will move up or down. Eventually, Investor B finishes ahead. Their portfolio spent more time compounding, while Investor A missed growth opportunities waiting for the perfect moment. Successful investing is rarely about the perfect entry point. Time in the market beats timing the market, because no one can consistently predict the future. For most people, the simplest way to capture this growth is through index funds and ETFs, which we will explore in our next video. True financial progress comes when you stop trying to master the timing of the market and start utilizing the unstoppable power of time. Imagine spending hundreds of hours reading earnings reports, parsing balance sheets, and tracking news cycles, hoping you picked the right stock. There is a different path. Acquiring fractional ownership of hundreds of America's largest corporations through one single investment. This approach gives you immediate exposure to companies like Apple, Microsoft, Amazon, Nvidia, Google, and Walmart. The simplicity of owning the entire market at once is the primary reason millions of people choose the S&P 500 to build their wealth. The S&P 500 itself is an index, a theoretical list of companies, rather than a single asset you can purchase directly. To gain actual exposure to this list, investors use financial vehicles specifically engineered to mirror its performance, known as index funds. This diagram illustrates the mechanics. The fund pools capital from many investors to purchase the underlying stocks in the exact proportions found on the list. Matching the market through passive investing removes the requirement for complex analysis, lowering the entry barrier for everyday people. While traditional index funds are common, many modern investors prefer exchange-traded funds, or ETFs, for their added flexibility. Unlike older fund structures, an ETF trades on the open market throughout the day, allowing you to buy or sell shares whenever the exchange is open. If you search for S&P 500 investments today, you will likely see three dominant ticker symbols: VOO, SPY, and IVV. VOO attracts long-term investors through its low expense ratios, while SPY is frequently used by active traders for its high daily volume and liquidity. Despite minor differences in their history or costs, all three instruments serve the same purpose of tracking the identical index. To buy these ETFs, you must first open a brokerage account, which serves as your connection to the broader stock market. Modern brokerage apps allow you to start with small amounts of money and purchase shares with a few taps on a smartphone screen. Many people also choose to invest through specialized retirement accounts to optimize their long-term returns. These accounts provide tax incentives that make it easier to maintain and grow these investments over a 30 or 40-year period. Since these platforms make the process accessible and cost-effective, the primary challenge is no longer technical. It is the investor's ability to remain consistent. New investors often struggle when they see market prices fall. Fear and negative media headlines frequently lead people to stop their contributions at the worst possible time. Dollar-cost averaging solves this by turning investing into an automated, systematic habit. This strategy involves committing a fixed amount on a regular schedule, regardless of whether the market is rising or falling. At a market peak, your contribution naturally purchases fewer shares. Conversely, when the market declines, that same amount automatically buys a larger volume. This mathematical routine redefines market volatility, turning periodic price declines into a systematic tool for accumulating assets. Consider the investor who waits for the perfect moment. They sit on the sidelines for years, researching and timing the market. Now look at the investor who simply buys a diversified index fund every month without trying to guess the market's next move. After a decade, the person who participated consistently is likely to be ahead of the person who spent those years waiting for a perfect entry point. Owning the S&P 500 represents a collective wager on the sustained growth of the leading American businesses. Building generational wealth involves committing to a consistent routine over decades, rather than attempting to execute a single, flawless strategy. Many investors treat the S&P 500 as a flawless wealth-building machine, but every investment has a breaking point. Stocks, real estate, gold, and certainly this index all possess inherent vulnerabilities. Entering the market during a bull run often creates a false sense of security. Rising portfolios and positive media coverage make investing feel effortless, as if growth will never end. Then, reality arrives. A sudden recession, a geopolitical conflict, or a global pandemic hits without warning, reversing years of market momentum in a matter of days. The S&P 500 provides no natural shield against these events. When the broader stock market is falling sharply, the value of this index moves down with it. As the decline deepens, the public narrative shifts rapidly. Initial hopes for a temporary dip vanish, replaced by widespread panic as newsrooms begin questioning the safety of every dollar. Market crashes are a guaranteed repeating feature of financial history. Accepting exposure to these severe drops is the foundational risk every S&P 500 investor assumes. The structural losses of a market crash are often secondary to the psychological toll extracted from an unprepared individual. Watching a portfolio evaporate triggers a downward emotional spiral. Initial optimism fades into fear as losses compound, and social media amplifies the sense of impending catastrophe. This emotional exhaustion is what eventually breaks an investor's logic. It drives them to abandon their long-term strategy and sell their holdings at massive, permanent losses. An investor who expects constant growth will be shattered by the first major correction. Psychological preparation for loss is a mandatory requirement for long-term survival. Owning 500 different companies sounds like an equally balanced, perfectly diversified portfolio. The internal structure of the index suggests otherwise. The S&P 500 uses market cap weighting, meaning the size of the largest corporations gives them disproportionate control over the index's performance. This system has caused massive concentration within a single sector. Today, technology companies dictate a significant portion of the index's movement. This means individual titans, like Apple, hold an outsized influence over your investment success. Other major players, such as Nvidia, carry similar weight. The index is fundamentally dependent on the continued corporate success of these specific giants. The dot-com bubble serves as the ultimate historical warning. When investors over-concentrated in the tech sector under the belief it was invincible, the eventual collapse led to devastating losses. Market cap weighting transforms the S&P 500 into a top-heavy structure. This leaves it deeply vulnerable to the failure of the few companies that carry the most influence. There are also strict geographic boundaries to consider. This index is designed exclusively to capture the performance of American corporations. This excludes the massive scale of the global economy. Thousands of major businesses in Europe, Asia, and emerging markets operate entirely outside its reach. Relying solely on this index requires a permanent bet that U.S. innovation and economic power will forever outpace every other international market. A second structural omission exists in the size of the companies included. The S&P 500 is restricted to large-cap businesses. By excluding smaller businesses, the index misses the explosive, exponential growth phases that define the early life of the market's future giants. Ultimately, the S&P 500 is not a complete global portfolio. It is a highly concentrated, localized bet on the dominance of large American corporations. Informed investors don't abandon the S&P 500 because of these risks. Instead, they use complementary investments to patch its vulnerabilities. Blending the index with international funds dissolves the geographic boundary and reduces reliance on a single nation's economy. True resilience requires assets that behave differently under economic stress. A defensive strategy must expand beyond equities to absorb broader market shocks. Many investors add stability by holding bonds, real estate, or commodities like gold, which often hold their value when stock prices fall. Spreading capital across borders and asset classes builds a defensive layer meant to protect wealth during severe market failures. Despite its structural limitations, the S&P 500 remains one of the most powerful financial engines ever created, if it is used correctly. A strategic investor monitors its specific risks: the frequency of crashes, the tech sector weighting, the geographic restrictions, and the lack of exposure to smaller companies. Beginners often search for an impossible, risk-free investment. Strategic investors, however, engineer balanced financial systems by assembling specialized, interlocking components. Acknowledging the limitations of the S&P 500 is the first step towards building a resilient portfolio, one capable of surviving the unpredictable realities of the global market.